Well, hello, everyone. Welcome back to another episode of the Money Lane. If you haven't listened to us before, my name is Chad Warmbine. With me is Keith Warmbine, my dad. My dad's been a retirement plan 401k advisor on the PITT OHIO plans for over 30 years. You know him from Terminal Tour. We're here live in the PITT OHIO Communication Studios, PITT OHIO headquarters. Special thanks to Candy Cybader, Jackie Ward, Timberger behind the scenes, getting this all together in this cool studio. And obviously Chuck Hamill, David Hamill, and all the people that have helped this get off the ground and running. The goal, as always, for the PITT OHIO Money Lane podcast is to give you timely and valuable information about the financial benefits that are available to you here at PITT OHIO. We do that hopefully at least once a year via the Terminal Tour. This is a much more efficient way to get your information in a timely manner. And we're sitting here today. It's April 8th, 2026. In this episode, as episode 4, as we're calling it, we wanted to give you a quick investment market update. We do have some things to say, obviously, when it comes to the investments that are available inside the 401k plan at PITT OHIO. We like to talk about the markets. We talk to employees from PITT OHIO all the time about the markets. And if you ever want to talk about it, I'm willing to do so. It's one of my favorite things to talk about. So please give us a call if you have questions on your investments. Obviously, in the past year and a half, things have changed as far as record keepers go, investments inside the 401k. So we thought it'd be a um, um, timely time to sit down and give you a quick market update. With what's going on around the world, obviously, it is a very timely thing to talk about. And I think you're going to be surprised by some of the statistics that we're going to share here in a minute and some of the slides that we're going to show you. But I'll send it over to you.
Yeah, so thanks, Chad. We're getting calls from time to time, people a little squeamish and nervous about the market. As you all are aware, we have a war going on in the Middle East, and anytime there's geopolitical tension, the market unfortunately reacts to it. So, just as a reassurance, this too shall pass. As any problems we've had in the past, in the world, we get by them. We're gonna talk a little bit about history, in this episode. Chad's gonna share with you some, great, slides here, uh, points in history where the market, we thought, the sky was falling, and indeed it's not. Today, or yesterday, I guess I should say, a ceasefire was reached in the Middle East for the next couple of weeks, and we know this morning that the market is reacting to that news already. The market will be up, or should be up, substantially today, right?
So yeah, some people call us and ask about what the market's doing today. And I tell people all the time, some days I don't even look at it, right? Because I know it's a long term, especially for your retirement accounts, it's a long term thing. We deal with a lot of retirement accounts. So just some quick numbers that I want to share just to give you an idea. Because when we talk to people, I'd say 7 out of 10 in the past month think it's a little crazier than it is. So as a gauge on how the market is done, we like to talk about a couple different market indexes when we talk to individuals. The S&P 500, number one, the S&P 500 is the 500 largest companies in the United States. So when you hear on the news what the market's doing, normally the expert or the person on the screen is talking about the S&P 500 when they mention the market. The market was up, the S&P was up 17% in 2025. As of April 1st, we like to use as of dates so we don't get in trouble with compliance. As of April 1st of this year, from 1/1 to 4/1, the market is down 4.4%. I would think that more people think it's down more than that with what's going on in the world with geopolitical, inflation, interest rates, all the things going on. The NASDAQ 100 tech sector. A lot of people like to look at that indicator and market. As of 4/1 of 2026, it's down 5.8% year to date. As a surprise, we tell this to everybody, the MSCI World ex-USA index, that basically means the world economy, stock market outside of the United States in layman's terms, believe it or not, was up 32% in 2025. And as of April 1st, it's up 2.8%.
I don't think you covered the, NASDAQ, what it did in
The
2025.
NASDAQ tech sector was up about, I believe, 20%. I don't have it down on my sheet for
That's why.
2025, but I believe it was up about 20% in
Okay.
2025. And that's the tech sector. The U.S. aggregate bond index in 2025, that's corporate bonds, municipal bonds, government bonds, was up 7.3% in 2025. And as of year to date, as of April 1st, it's basically flat. It's up 0.1%. And I'll get to why we're mentioning all these numbers in a second, but a 60% equity portfolio. So if you were invested in the SP 500, 60% of your portfolio was invested in equity and 40% of your portfolio was invested in bonds last year. You were up 15%. And the reason why I mentioned that is, as we mentioned in our terminal tour last year, you had the ability to change your investments inside your 401k account, the 401k portion of the account to the Fisher Pro Series. And hopefully everyone, if you knows that you're in those now. But to give you a gauge on how the Fisher Pro Series has did last year. So the All World Equity Fund, that's a portion of your 401k, was up 30% last year. That's a 3 and a 0. And as I had mentioned, the S&P 500 was up 17. Okay. And as of 4/1, it's down 2%, and the S&P is down 4. The U.S. fixed income Fisher Pro Series investment was up 6.9% in 2025. And as of April 1st, year to date, it's down 0.14%. So you want to talk about any of those numbers real quickly?
Well, I just wanna say again, we hired Fisher for a reason. They are best in class. They are number one when it comes to managing money out there. If they're being compared to the the target date industrial complex, um, as far as managed money goes, I think it's important that we say it again. Fisher had a return last year in their all world equity fund of 30%, um, just beating the pants off of the S&P 500. So I think it's important to note that they were brought into the 401k for their performance numbers over the last decade.
They've
So
done, yeah, a terrific job. And
yeah,
anything else?
that's it.
So as we had mentioned at the beginning, I want to go through some slides here, real quickly. Um, from an investment company, a large institutional investment company that we go to for research called First Trust. And the reason why I want to go through these is going to kind of hammer home some of the points we're mentioning. Right. Number one is getting invested. Number two is staying invested. Timing in the market. It's impossible. Literally impossible. People always ask us, is it a good time to get into the market, get out of the market? And I wish I had a crystal ball. If I could guess it, I probably wouldn't be sitting in the studio right now. No, I'm joking.
Yeah,
Um,
I had someone call last week and ask me if it was time to sell. And you've heard me say it before. I say it almost every terminal tour. The worst time to get off a roller coaster is when it's going downhill. You wait for it to come to a complete stop, and then you exit. You don't exit the market on the way down. You have to look at that as a buying opportunity because share prices are now on sale. So I think it's important that we talk about that again. So to that particular gentleman that called me last week to say, let's get out, I said, no, let's stay in. Things will be okay. They'll calm down. And we're going to talk about that right now.
yeah. Starting on this chart, this slide. So, um, I use this a lot with clients, and people I talk to, and I refer to it, I should say, with a lot of people. So, what this shows is going back to 1970 and all of the geopolitical or events that have happened, not all of them, but a lot of large events that have happened in the history of the S&P 500. What it shows is if you had $10,000 invested in the S&P 500 in 1970, got invested, stayed invested, went through all of these different scenarios and things that have happened during those times. Things like the first mobile phone being sold, the Cold War ending, 9/11, Hurricane Katrina, Lehman Brothers, 2008, the financial collapse of Lehman Brothers and the Great Financial Crisis, Ukraine crisis, COVID-19, and obviously, most recently, the Iranian crisis that's going on currently. What this shows us is that geopolitical concerns are always going to be around, and they will continue to happen. I'm 37 years old. I'm going to be invested for the next 40 years, right, until I retire. And there's going to be a ton of them that happen then. And anybody out there, you as well. This chart shows if you had $10,000, got invested, stayed invested, you would currently have 3.5 million. Alrighty. Talking about getting invested and staying invested. So know that unfortunately, geopolitical concerns are always going to happen. It's just a thing that we have to go through as investors. Moving on to the next slide, real quickly. I think we shared this in the terminal tour. I
We
like to
did.
share this again. What this chart shows, and there's a lot going on, but on average, every single year, the S&P 500 does have a downturn. On average, since 1980, it shows there's about a 14% at some point during every single year, where the stock market will go down about 14%. Some years it's lower, some years it's higher. Um, Back to the point of getting in and out of the market. We've had some severe swings the first quarter of this year when the market was down 2% or more on the day. And today we had talked about, as we had mentioned before we were coming in this morning, the market was showing that it was going to be up maybe 2.5%, 3%. But know that volatility is normal. For the past 10 years, we haven't seen a lot of volatility. And so knowing that it's normal. Next slide.
I think one of the best illustrations here is to go back to March of 2020. As Chad indicated, these are inter-year drops in the S&P 500. When COVID came out in 2020, the S&P 500 in March dropped 34%. And most of you didn't even see it because it came back so quickly. It was a blip. So don't get real caught up in the drop as that gentleman did last week that called to say, let's get out of the market. We're going to have these periods, and I just wanted to knock that home.
Moving on to the next one, and I love this slide a lot, especially in recent events, with people asking us, where's the best place to put our money? I like to talk about stocks. Know that from the very basic of what investing in a stock means. When you buy a stock, you buy into a company. You're investing in a
Ownership.
company. You own a company. So if my Apple iPhone's sitting right here, I buy Apple stock because Apple's a great company, right? You own part of Apple. This slide shows the S&P 500 going back to 2007 and the annualized return. Yes, it also shows gold, 10-year treasuries. It also shows the CPI. It shows home prices, also what cash is earned in oil prices. But it shows that over the long run, investing in stocks, investing in the great companies here in the United States as well as abroad pays off in the long run, and you will grow your money. Next one shows, I'll couple of seconds on this one, not too long, but it's really busy. But bull and bear markets. Bull markets are when the market goes up. Bear markets are when the market goes down. What this slide shows you is that the average bull market period lasted 4.4 years on average, between the years of 1942, I wasn't around back then, to 2025. The average bear market lasts 11.1 months. So bull market, 4.4 years. Bear market, 11.1 months. If you look all the way over to the right here, the current bull market is at 3.2 years. So what does that mean? That means we may have another 1.2 years of this market going up on average. That's just an assumption that I'm not
No
saying it's going to
guarantee.
happen, but know that on average, bull markets last almost 4 times as long as bear markets. Back to the point of getting invested and staying invested. I don't know when the best time to get out of the market is. Moving on to the next slide. This is a really cool slide because staying invested. This shows growth of $10,000 invested in the market from 1979 to 2025. If you were invested the whole time during that time period, you would have about $2 million. If you got out of the market and missed the best 5 days of the market in those years, you would only have 1.2 million. If you got out of the market and you missed the best 10, 873. And I'll skip ahead to the right side of that. If you missed the 50 best days of the market during those years, how many years is that? About 50, 46 years, right? You would only have 134,000. So you can see what we're getting at here as far as getting invested, where the markets are. There's a lot of volatility. And I think I only want to share one more slide in here. But if you want, we can always share these with you. And then one more slide just to show you what it means to invest in the S&P 500. So this shows 100 years of investing in the S&P 500, going back all the way to 1926. In those years, we've had 74 positive years in the stock market. We've had 26 negative years, and the average return on those negative years has been negative 13.4%. The average return on those positive years has been 21.4. We will have years like 2008, and I was in college during that time. I wasn't. I studied it. I always say. We're also going to have years like 2022, if you don't recall that which is only a couple years away. Years ago, what was it down in 22? It was down 18%. So we are going to have those down years. What this shows you is if you invest for the long term in stocks, people ask all the time, aren't stocks very aggressive and can I lose money? Yes, you can. But if you invest for the long term in your retirement, you can annualize, as you can see on the screen, 10.3% over the long haul. Anything to
Timeout.
add?
Yeah. I just wanted to call a timeout. You use the term lose money. You can't lose money unless you sell the position. I just want to make that clear. And we talk about it all the time. If you sell out of a position, you realize the loss. If you hang in there, you're going to come back, right? So to lose your money in the S&P 500 is nearly impossible. You're investing in the 500 largest companies in this country, and for you to lose all your money, they have to go out of business on the same day. So you're not losing money. You're going to see fluctuations in share price. Some people call it a paper loss, and that's exactly what it is. It's just on paper. So hang in there, stay invested.
Um, that's all the slides I wanted to share for now. But I would say to bring this full circle, if you don't know how you're invested inside your 401k plan, I say this every terminal tour meeting, please call us.
Yeah.
That hurts my heart just to think about it. If you have questions on your performance, please call us. We just mentioned the Fisher Pro Series. If you were 100% in equity in the Fisher last year, you made 30%. If you're 100% in bonds, you made about 7. So everyone made money last year. Hopefully you're invested, right? And then if you have concerns, our first episode of the Money Lane, which will be shared shortly, was about the retirement roadmap. And if you're within 5 years of retirement, it's really an important time to understand. We talk to people all the time
Yep.
about getting ready for retirement. What's that mean? Listen to that series. That's episode 1. But knowing how you're invested within the last 5 years of retirement is getting to be pretty important, right? Because no longer is it about growing your money and being aggressive as possible. It's about conserving the money and making sure you conserve the principal that you've saved for however many years you've saved for. So with that being said, anything else to add?
That's it for now.
Episode 4 of the Money Lane. If you have any questions on your investments, please call us, and we appreciate it.
Thanks for tuning in.